Permanent working capital.
Not all current assets will increase your cash in the next year. This can happen when increased sales drive increases in accounts receivable or inventory. This is called permanent working capital.
Permanent working capital is the amount of working capital that a company consistently maintains. It's the net current assets you'll never receive in cash until you no longer operate or your operations significantly decrease. The biggest source of this is the timing of your cash conversion cycle. For a company that sells goods, you will need to buy a large amount of inventory to stock your store or warehouse. You will constantly have that amount of inventory until you close. Also, the longer it takes to collect cash from your customers, the larger your permanent working capital. Service companies have a similar cycle. They must hire and pay for staff to provide services. In a sense, the inventory of a service company is the service delivery capability of the staff. Once those staff are trained, they provide services that are billed to the client or customer. Those customers often have time to pay on the invoice, which creates accounts receivable. The staff are paid long before the cash is collected from the customer. Since both products and service companies have similar dynamics, I'll use a product company in the examples. In this first example of a startup company, the company buys $50,000 of inventory before opening. They have $50,000 of seed capital from the owner. This company pays for goods 1 month after receiving them, and they also receive cash from customers 1 month after the sale. In month two, they sell $10,000 worth of goods and restock the same amount. For simplicity, I'm showing a company that sells goods and buys goods at the same price. This is obviously not a good strategy in real life. I'm doing this to isolate the changes in cash to only those due to changes in working capital. In real life, a startup company may earn a margin on their sales, but advertising and other overhead costs are likely higher at the beginning months of the company. In month two, they pay for the inventory they bought in month one. In month three and going forward, they are always receiving $10,000 from customers and paying $10,000 for inventory, so their net working capital is always $50,000. The company is solvent because of the $50,000 capital infusion. Imagine if the owners hadn't put in a capital infusion but instead took out a short term loan. The company becomes insolvent once the loan is due. What's more common is that the owner uses credit cards to fund the business. They pay a very high interest rate, which must be somehow funded. Those funding costs, along with the other cash flow pressures of a new company, eventually bleed the company's cash dry. Existing companies are subject to the same spike in working capital when they have a spike in growth. Here is the analysis of a growth spike for an existing company. The company has $10,000 in sales per month and many of the same assumptions as the startup company. Once again, I'm setting sales equal to the cost of goods to isolate cash flow changes to only those due to changes in working capital. The company has been selling $10,000 for many months. In month two of the analysis, the CEO proclaims that the company is going to 5x sales. To do this, they need to increase their inventory to $150,000, which is only 3 times larger than their current inventory. Once again, this spike in inventory completely depletes the cash. Total assets, which in this simple example are all also current assets and thus gross working capital, spikes from $160,000 to $260,000. Gross working capital then levels off at $200,000. Net working capital stays consistent at $150,000. If the company had not started with $100,000, they would have had to get a capital injection from the ownership or some other source of long term funding. In the real world, they would likely have a positive net margin and potentially a positive net income. This would accrete cash to fund the growth, but this will take months to accumulate. However, big spikes in growth in the real world also require investments in staff, equipment, and people. These all drive up overhead. Like the startup, this investment will require money and will likely depress earnings before increasing them. This means that before growth occurs, a company must not only fund the increase in gross working capital on the balance sheet, it must also fund the sum of net negative cash flows due to overhead exceeding the increase in gross profit. We see the opposite effect of cash when a company winds down. Companies or products in the late stage of their life are often called cash cows. The cash from this cow is milked from stable but declining gross profits. It's also milked from the release of formerly permanent gross working capital. The example here once again sets gross profit to zero so we can see the cash flows from changes in working capital only. Sales are dropping for this example company. They are allowing inventory levels to drop with sales. This increases cash balances. In month four, the cash accumulated from the wind down is distributed to the owners. The distribution reduces cash, gross working capital, and net working capital. When companies have low cash balances and can't reduce their working capital accounts through efficiency, they sometimes shrink the company to get cash. This mirrors the cash flow dynamics of this cash cow example.